Hey guys, it is a random stock day. So let's pick our random stock. I've already done that. The random stock that we're going to look at today is Asana. Ticker symbol ASAN. Here's the interesting thing that I want to talk about today is this stock is down, and it is down quite a bit. It's just hovering right above its 52-week low. Its 52-week low was just pulling this up on Yahoo Finance, their summary page for Asana. Their 52-week low was $16.20. It is, as of the time that I'm recording, $16.63. So the question is, does this deserve more of our attention, right? I want to point something out to you about Asana Stock, and that is year to date, it is down 76.8% from January 1st. That's nothing though. Its 52-week high. Its 52-week high was $145.79. So it's come down almost 90% from its 52-week high, which is an astronomically bad performance. It was one of these hype stocks last year. I've never owned Asana. I actually have a buddy who used to work for Asana, and he was telling me that like last year that something like 75 or 80% of his net worth was tied up in Asana stock, which was granted to him as an employee. And I was like, that is nuts, right? I was like, you need to start selling some of that and diversifying it. That's just a large percentage of his net worth. And I believe that he actually did take me up on that advice to diversify out of Asana right near its peak. So good for him. So let's start talking a little bit about Asana stock, Asana the company, right? So the first thing that I want to talk about is where it sort of sits in the hierarchy of quote investment grade unprofitable companies, right? So investment grade unprofitable versus speculative unprofitable. Wow, I can't say that. Speculative unprofitable companies versus investment grade unprofitable companies. Let me tell you about the difference here, at least in my mind. The difference is, do you see a path to profitability? How long is it going to take? And can you discount that back? And then you start making assumptions about, whether or not the company is going to be able to make it to a profitable state. And then you can start talking about, what the value of this company will be once it gets to a profitable state. And it can be that it's profitable in terms of free cash flow, but not in terms of net income. So there's a little bit of fudge room there. But the idea behind whether it's investment grade or whether it is a speculative thing is, can I actually calculate out when this thing is going to be profitable and come up with a price? And the way that you tell that is through the they're the return on incremental invested capital. That's what's going to tell you if the company is actually moving in the right direction. So what we're going to do is we're going to pull up the financials on Yahoo Finance again, and we're going to look at basic earnings per share, and we're going to see what direction that moved in, because that's going to tell us a lot right there. What I can tell you is that as of January 31st, 2022, Asana had a loss of $1.63 per share. That's up from 4 years ago on January 31st, 2019, where their loss was only 34 cents a share. All right, so they're moving in the wrong direction in terms of their net income, right? Let's see how bad that actually is, because what you want to know then is, are they issuing more shares? Is that they're probably going to have to issue more shares if they're taking a loss like that. They're a young company, right? So one of the things that you're going to want to look at is number of shares. You'll take a look at the balance sheet for that. Pulling up the balance sheet, shares issued, and that has been climbing quite a bit. It's up to, what is that, in thousands? They started out 4 years ago at 151 million shares. They're up to 188 million shares over 4 years. So they've issued a ton of shares. And frankly, rightly so, if they had quite a bit of a run up. I don't actually, that doesn't really bother me too much. It definitely does bother me because they are diluting. But for a young, unprofitable company that's sort of getting its legs underneath it, that's sort of part and parcel with the game, right? And it's going to factor in if you do the calculations correctly in terms of its discounted cash flow model, right? You'll be able to tell that you're going to see that gets discounted pretty heavily at the beginning because on how much the company is worth, because they are losing money. The good news is that they've basically converted those shares that they've sold to cash. It hasn't been converted to assets yet, which means that they have a lot of flexibility. Their liabilities went up through 2021, but by 2022 they started to come back down, which is good. One of the good things that I'm seeing here also is that their equity per share, their book value, went from a negative value to a positive value by the end between 2019 and 2022, which is a very good sign. Yay them. So, but what I can tell you is because their loss per share is growing, their return on incremental invested capital is getting worse. Period. Right? So we don't even have to do the denominator piece of that puzzle to determine that. So the question now becomes, okay, so it's not profitable. What's its return on invested capital using free cash flow instead of net income as the measure for whether or not the company is growing or not? So we'll pull up the cash flow statement. We'll look at their free cash flow. Again, I'm doing this on Yahoo Finance. Anybody can pull it up. And their free cash flow went from negative 33 million to negative 144 million. So that's moving in the wrong direction as well. Guys, to me, it makes a lot of sense that this is not going to get classified, at least in terms of my thought processes, as an investment grade unprofitable company. I don't know when it's going to become profitable. I can't divine that from this information. There's nothing here that says that this company is going in the right direction. All of these metrics are moving in the wrong direction, and it makes a whole lot of sense that they're down almost 90% from their peak, because frankly the company is not doing what an investment should do, at least in my opinion. This company appears to be mostly speculation at this point. Does that mean that it's not going to be a great company? No, right? The thing that you're doing at this point, though, is that you are saying this is a gamble, right? A company with these characteristics is a gamble, because you can't actually calculate anything about where it's going to be, where it's going to land. This company is a gamble, which is okay, right? Venture capitalists make a ton of money gambling, essentially, and the way that they deal with that is they spread out the risk over lots and lots of different companies. Some of these companies get acquired by other companies. Some of these companies grow into behemoths. Venture capital is all about these unprofitable young companies and sort of getting them into a position that can make the venture capitalists some money. Thing is that a publicly traded company with these characteristics, you have to buy a bundle of these because you don't know which ones are going to make it and which ones are going to fail. For every single company like this company, Asana, that you see with the same characteristics, maybe 1 in 10 will make it, right? Things are moving in the wrong direction for this company in terms of its net income, in terms of its free cash flow. And so the return on incremental capital is not going to be there. It's going to be a negative number, which just sort of means that it's spiraling downward, right? Can they turn it around? Yes, they can. When will they turn it around? Your guess is as good as mine, which is why I classify this under the speculative, unprofitable companies. It's not something that I put money into. Right? I would consider putting money into the investment grade unprofitable companies, which have positive returns on incremental invested capital, especially if if the return on incremental invested capital is really, really high. And you can start to see, okay, this is, you can sort of use that to project out when this company is going to be profitable, at least from a free cash flow perspective, right? And then from there, you can do your discounted free cash flow model and come up with a price. And the fact that it's going to be front loaded with all these negative numbers means that that price is going to be much, much lower probably than what you would think. And that would mean that this little company that you're looking at, right? This little company that you're looking at, that's gonna take into account the fact that they're gonna need to dilute you through share issuance, and you won't be fooled by what seems to be a decent price for a company, when in fact it's a terrible price, right? But that would be an investment grade, right? Because you can calculate a value. You might be wrong, right? But at least you're going into it with some sort of expectation. A company like this, it's like shooting in the dark. You don't know what you're going to get. Okay, so that's all that I've got today about Asana. Again, I wish I could say more. I hope that nobody lost money on this thing, but it has been a wild ride for people who have bought into it in 2019. Because if you bought into it in 2019, you watched this company go from $25 a share all the way up to its high of $141 a share, back down to $16 a share. That's what I mean by this is a speculative company, right? You got to buckle up and ride the ride if you're going to be doing it. But that's all that I've got today. Good luck out there and stay rational.